Well, good morning, everyone. We're back for day 4. We are back for our separate webinar series looking at the new year, new tax year ends coming up into view. Obviously, 31st of January, 6th of April, all key dates in any financial finance or accountant's diary. So today we're focusing on SEIS. Every day I woke up at the moment, I think today can't be any crazier than yesterday. And then America happens, all the stuff last night, absolutely crazy scenes in America. Yeah. What is today going to hold? That's what I'm trying to work out. Surely it can't be any more crazy than it is at the moment. But today, more importantly, it's talking about SEIS. So we have 4 fantastic panelists in front of me here. I'm going to go left to right and ask them to introduce themselves. So Joseph, do you want to go first?
Hi, everyone. So I'm Joseph Zipfel. I'm the Chief Investment Officer at SFC Capital, formerly Startup Funding Club. We've been operating an SEIS fund since 2013-14, which has now become, I believe, the largest SEIS fund in the market. We've got over £20 million under management of SEIS investments, over 200 portfolio companies. We also operate an EIS fund as well as a regional fund backed by the British Business Bank.
Brilliant. Thanks so much, Joseph. Left to right, so that's Ewout.
Hi, good morning. I'm Ewout. I'm the head of tax advantaged investment with Tilney Smith & Williamson. We're a whole service financial planning firm. We also have investment management and private tax consultants. So we do the whole width and breadth of financial planning these days. I'm responsible for all SEIS, EIS, VCT, and IHT research for the firm. I'm delighted to be here. Happy New Year.
Happy New Year, Ewout. Thank you very much. You are, as always, our financial planning representative, so the most important person here. Boyd, over to you.
Hi there, my name is Boyd Carson from Sapphire Capital Partners, and we specialise in SEIS and EIS funds. We've done quite a number of SEIS micro funds, I would call them, sort of the £1 million range. We've been doing it for about 5 to 10 years now, and we've about a total of about, I think, 4 or 5 SEIS funds. Very pleased to be here. Thank you very much.
I'm going to say, it must be 10 years for SEIS. It began in 2012,
yes.
didn't it? So, 10-year anniversary.
Time slips away very quickly.
Indeed. Thanks, Boyd. Alex, last but not least.
Yeah, I'm Alex Davies. I'm founder of Wealth Club. We are the largest non-advisory broker of VCTs and EIS and other tax-efficient products. We've been around since 2016. We've got about 5,500 clients who've invested £460 million through our platform into VCTs and EIS.
And we were just talking beforehand, you're saying you're very busy at the moment. Obviously, people locked down at home and busy really looking at their investments.
Extremely busy. In fact, we've never been so busy, which
good sign. Absolutely. Okay, so I'd say SEIS is the focus for today. SEIS very much plays often second bill to EIS. I know when I talk about SEIS, I always talk about EIS. I don't talk about SEIS, mainly because it's a bit of a mouthful to say EIS, SEIS all the time. So I kind of abbreviate it to EIS. But we want to put that straight today. We want to really shine a light on SEIS. So we're going to look at how SEIS differs to EIS, not just in terms of tax relief, but also investment strategies, portfolio management, and how they work towards an exit at the same time. But to kick things off, it might be worth just having a bit of an SEIS 101. So Ewout, can you just run us through the differences between SEIS and EIS, both on the tax side and mainly on the investor relief side?
Yeah, no, absolutely. So the similarity is that they're both investing in smaller companies. They're both younger companies. Where it starts getting a bit different is that with the SEIS, you are investing in mainly younger companies than with EIS. And so the government has recognized that you need, to get a bit more relief, a bit more incentive to invest in these startup companies. And so you get 50% income tax relief for investing in SEIS versus the 30% for EIS. So that's already quite an attractive feature of SEIS. Now you are limited to £100,000 a year in SEIS, whereas you can invest anywhere between £1 million and £2 million if you include the knowledge-intensive EIS. But so the normal comparison would be £100,000 SEIS and £1 million in normal EIS territory. So that is quite a difference. The other difference is that with EIS you can defer a gain, which means that, say, you have a tax bill, CGT bill of say 28% because you sold second property, you can defer that And then when you come to sell the EIS, you simply have to repay the CGT that or the gains that you've deferred. With the SEIS, the big difference is that you can offset half of the investment against your gain liability for the year in which you want to make the investment, or you use carryback for last year. But so £100,000 gain would effectively cost you, if it's a CGT on the property, would cost you £14,000 as opposed to £28,000. So that's quite a good saving. The similarity again is that any gain on the sale of the SES is tax-free, just like with an EIS. And just like with an EIS, you don't really want an income from the SES because that's fully chargeable under income tax. So that's a high-level comparison.
Thank you very much. No, it's good to hear kind of the investor side, because obviously when SEIS came in 2012, as I say, that reinvestment relief was a full 100% exemption, wasn't it? But now it's down to 50%, which is still incredibly generous. Boyd, I'm going to come to you with a question.
That's what I was going to say. Back in the day, first year, you could actually make, I think, 104% in the right circumstances if you lost everything.
Yeah, I think it's the old 104%, wasn't it? I remember seeing that on a few flyers and promotional materials at the time. Yeah.
And now, with the right conditions, so this is for additional rate taxpayers because loss relief still exists on the net contribution. I think it's about a 13.5% net exposure you've got to an SEIS investment. So that makes it, oddly enough, for the right investors, the lowest risk of all the tax advantaged investments, which makes you wonder why not more people are using it.
Yeah, true. I guess it's got to be a particular set of circumstances, which mean you get that 87% protection. But yeah, it's, I guess, available in that sense. So yeah, good point.
Mark, can I add to that?
Yeah, I was going to say, yeah.
It's not really, I'm not going to point out, it's not really a tax difference, but it's more of a difference in the age of the companies. An SEIS company has to be less than 2 years trading, whereas an EIS company has to be less than 7 years trading or up to 7 years trading, which is I know it doesn't relate to tax, but it's a fundamental difference between the two, and it very much denotes the age of the companies and the risk that you're taking.
Yeah, I was going to say, I was actually going to come to you and ask, because Avard's obviously given the investor side of SEIS. I was going to ask the company side of it. So you've already mentioned the 2-year rule. Thank you very much for chiming in with that. Do you want to explain a bit more about the differences between SEIS from a company's point of view when they're applying for it?
Well, sure. From an actual application point of view, from a compliance point of view, the HMRC application itself is pretty much the same. But apart from certain rules, such as that 2 years for an SEIS company from a trading perspective and 7 years from an EIS. And it's important to point out that the 2 years could be any form of trading. For example, if you put on Facebook that you have a product for sale and you don't actually sell anything, that is deemed by HMRC to be actually a trading activity. So there is very important differences between the two. But from our perspective, that's what makes SEIS so attractive, in that it is a young company, it is a startup company. That's what it's all about. And that allows us as investors and investment managers, etc., to mold that young company and help it and give it the support it needs. And that's why I think SEIS is so attractive for investors, because you're really getting in at the very early stage, i.e. less than 2 years, as the rules say.
Yeah, I gotta say, yeah, you're absolutely right, because it's literally, I always kind of say it's a back of a fag packet company. Literally, you literally got the company up and running. You literally got it started. And Avar mentioned that investors can put 100,000 in. Obviously, for a company, they can only take in 150,000 through SEIS. But these are kind of pre-revenue, very much a long way probably from profit companies that they are literally getting going. They probably might have a proof of concept, maybe, possibly. Actually, it's probably a good time to bring in Joseph, because he knows way more than I do about the type of companies that you would invest in via SEI. So yeah, do you want to pick up the thread there, Joseph?
Yeah, what I would say is always good to remind ourselves that every company at some point at the beginning is an SEIS company. No matter how successful you had to raise your initial startup capital. So the way I think about it is our job is to identify that high level potential quite early on and be the first money in potentially very successful companies. So the flip side to that is that the upside of your investment is huge. It's quite it's quite common for successful SEIS investment to go up in value, 5 times, 10 times, sometimes even more. We had 100 times exit last year on one of our early angel investments, so that was obviously fantastic. So, but yeah, every company is going through that stage at some point. So our job is really to find them at the very beginning and identify the potential early on.
Yeah, I don't know if you saw it. There's a kind of a posting around on Facebook recently that showed the early investors in Uber, I think it was, saying that their 10,000 had turned into 16 million, or 6,000 had turned into 9.4 million, etc., etc. But as you say, that was the first money into that company, and that just shows what the breadth of return could be at that point. So, but Alex, I want to bring you in, because you haven't spoken yet. Just in terms of kind of the market with EIS and funds and companies, I know you do a bit of both on Wealth Club. How many are out there at the moment? Kind of what does the market look like? What are they investing in? Yeah, give us kind of a flavour of what's happening in SBI's market.
Well, it's a tiny market in terms of the number of funds. There's no definitive list, but typically there's about 10 funds raising at any one time. And, in terms of where they invest, in some ways they're very similar. They're all looking for very early stage innovative businesses that could give investors very high multiple returns if they go well. Mostly they're sort of technology enabled, and mostly they're disrupting a market. Other than that, they're quite distinct, actually. Even though there's very few funds, investors have quite a lot of choice in the areas their money could go into. So, for example, if you wanted to invest in companies that are benefiting potentially from the robotic revolution or the rise in robotics, there's a fund there specifically for you. If you want to invest in life sciences, there's 2 funds there specifically for you. Likewise, investing in sort of young British design companies, there's a fund for you. And then there's more generalist funds for probably, I would say, Startup Funding Club is the premier in that league, where you could invest in quite a wide range of companies, whether they're sort of technology companies, life sciences companies, or consumer product companies. I know, like, one of the Startup Funding Club successful companies actually makes paper straws. So it's sort of quite a wide range of investments. The other thing, obviously, is all the managers say how involved they get in the businesses. Now, I think they all do get pretty involved. Some get much more involved than others, and I think that's important. I think the other thing investors need to be aware of how many companies are going to be in your portfolio. And it really, depending on who you choose, there could be anything between 5 and about 25 different companies. And generally, we'd say the more the merrier. And the other thing you need to be looking out for in terms of your manager is, when are they going to invest your money? So if you give them 100 grand today, is that going to be invested over the next 12 months? Is that going to be invested over the next 2 years? Or will it all be invested in this tax year? And different providers have different approaches to that.
Yeah, I think it's been interesting seeing the evolution of SEIS since 2012. Obviously, when they first came out, and for the first couple of years, you saw kind of mega funds that were trying to invest in 45 different companies for an SEIS fund. Obviously, as a core investor, you're getting 45 tax certificates at the same time, probably over different tax years. But it does seem to condense down a little bit in terms of how many companies are being invested into. Again, probably a good time to bring in Joseph and Boyd. Boyd, I guess most of the funds you work with on SES front are probably more specific, and Joseph's are probably more general. But Boyd, do you want to talk about some of the funds you work with and kind of that I'm going to try and say this, specificity. Is that right?
Sure, yeah, absolutely. I mean, as Alex was pointing out there, some of the funds we work with, for example, is the British Robotics Fund, and it would specialize in that AI, that type of robotics, very, very niche, but obviously very important at this point in time, and has done very well. And again, another one that Alex pointed out there, British Design Fund, which invests in products that are designed in the UK. So that's really focusing on that type of IP, encouraging British entrepreneurship and design. And we work with other funds. There's another one, for example, the Fuel SEIS fund, which is just about to be launched, which is very, very technology focused. They've been very well known in the EIS sector, and they realized that they could have been investing in SES all along to help those EIS companies. So absolutely, there's lots of niche markets out there, as Alex mentioned. I just thought it would be very remiss of us all not to point out that there is a reason, sorry to go back on tax, but there is a reason why it's 50% tax relief, in that these are high risk companies. They doesn't get any higher risk than this. But at the same token, we have to remember that the reward is, as Joseph pointed out, is incredible if you get it right. But we have found that there is definitely a higher percentage of probably failures in the portfolio of an SEIS portfolio. But on the other hand, the companies that do well can do exceptionally well for your returns. So there is a bit of a trade-off there.
And your example of fuel's a good one, because like you say, fuel have been in the EIS market for a few years now, but they're kind of coming down the scale towards SEIS. Or what makes them want to do that? I mean, you think
we did analysis, or Fuel did an analysis that they realized, I think it was something like 60 to 70% of the companies that they were investing EIS monies into could actually have received as an initial tranche up to 150,000 in SEIS monies. So the logic is, well, why wouldn't you do that? Because it's a much better return for the investors, and you're actually helping the companies as well. So it made total sense to support those companies and give the investors a better return.
And I guess because the company can only raise 150,000, you can raise that pretty quickly, you can spend that pretty quickly, and then you move on to EIS quite quickly at the same time.
Yeah, so yeah, the plan would be, because you know you're going to do a follow-on, so their EIS funds actually become a follow-on fund rather than the first capital. So it works very well. You would seed the startups, and then you would pick the best ones and do a follow-on monies into them, and they were putting in 150,000 straight away to get them going. And Fuel is very strong in mentoring, so it ties into exactly to what their ethos is all about.
Joseph, I've mentioned Fuel there, but you've been doing this for years, I guess. In that sense, I guess you've gone the other way. You've had the SEIS fund, and now you've got the EIS fund, and obviously you've got British Business Bank money as well over and above that. So yeah, do you want to explain your philosophy and investment strategy as well?
Yeah, no, that, as I mentioned earlier, for us, it's about being the first money in. We do have the model that we do operate the model quite similar to what Boyd just explained. We have an EIS fund that follows on effectively in the best performance. So, you're the first money in these companies. So, they're extremely likely to come to you for the next round. So we're in this pretty good position to be in that. We've got an existing stake in the company. We've got a good relationship with the management. So they will come to us, and the best ones, we're really able to pick the best ones from our portfolio that now has over 200 companies. So it's a good model, especially if you think how competitive the EIS market has become. There's lots of EIS funds competing for the same deals. So it gives us a huge competitive advantage to be existing investors in some of them, and really be able to find the ones that we know are doing well. We know the numbers, we know they're doing well, but we also know the sort of behind the scenes story of how the company is run, which sometimes gives you a different picture, good or bad. So we're able to make much more informed decision on our EIS fund because of the STS investment that we've made already. So it's a good model. It works really, really well. One thing I wanted to add is that there's sometimes a very, very short timeline difference between the SCS and EIS investments. It can be part of the same round. The average round that we take part in is around 300K. The maximum you can raise on the SCS is 150. So already tells you that most funding rounds that we participate in have an EIS element to them anyway. So it's really about being the first investor to find a company and to make the offer and to lead that first round, which is what we do.
Yeah, I guess I should say there's got to be a day between the SEIS investment and the EIS. Right. Sorry, put my geeky technical hat on there. And Alex, coming back to you on Wealth Club, and this is my lack of knowledge, so apologies. Do you have many SEIS single companies on the club?
No, we don't, and I think it's almost impossible to pick single companies as a normal investor, unless you've got, these businesses are so early stage, it is so risky that unless you've got some inside knowledge of the business, it's almost impossible. And to go with a fund that's got a very clear process in place of how to pick those companies, that get those companies to come to them in the first place and develop them, then unless it's your particular area of expertise, you're an angel, etc., then you probably want to avoid it like the plague.
Yeah, that's a good point. As you say, these are super early stage companies. They're difficult to choose and select. So I guess a good point to bring Avard back in. When you're looking at funds, or I guess, again, you don't do single companies, but when you're looking at funds, what kind of due diligence are you doing over and above what you might do with an EIS fund? You're on mute, Dave. Classic.
It's really the same type of due diligence, because you're still dealing with the fund managers. You still want to deal with them from a what's your process, you know, who gets to decide what's your conflict policies. What I do think is more important with SEIs than with EIS is that how hands-on is the fund manager in mentoring the entrepreneur. Not all entrepreneurs that go into or that set up SEIS companies will have done it before. There's lots of young people or people coming out of business that have never run a business before, like come out of a large organization with a brilliant idea to set up their own business. So I think the mentoring bit is very important. I look at because I mean, Alex mentioned there's funds that do like 4 or 5 companies. I would expect them to be far more hands-on themselves as a team. Whereas companies that do like 25, 30 with Joseph, I would expect there to be more of a network that sits behind that of individuals that can help those companies. So I look at also the resources and how those resources are shared with wider networks. The key for me though with the SEIS fund is that there is an EIS fund to follow on. I'm not going to put an SEIS fund on the panel for our financial planners if there's no follow-on opportunities.
Okay, so you want to see the kind of the two working in tandem together in that sense.
Yeah, and I think also that investors need to realize that even with an SEIS EIS combo, there will be a time when the fund manager has to let go of those investments because they simply can't follow them afterwards. And this is where it becomes interesting to know who they would otherwise then work with. Together with other VC houses, other private equity houses, where they have got the good relationships going for that continuing. The other thing we've recently had with SEIS funds, and it's something advisors also need to be aware of, the good investment managers will obviously have preemption rights. That's a technical term, clearly, but it allows you as a fund manager to participate in a follow-on round. Now, if the EIS manager hasn't raised enough capital, say, for example, this year has been difficult for some fund managers to raise capital, then allow advisors with their investors to come alongside on an individual basis. So with preemption rights, I think there has to be far more of a conversation between the fund managers and the financial planners and their clients around the possibility of participating in preemption rounds.
Yes, I guess for like financial planners, just understanding the fund that you're going into and whether it has these kind of things like preemption rights and dragon tags and all these kind of things as well. Yeah. That kind of brings me to the point I was going to mention as well about appropriateness. So financial planners, Tilney, for example, would they all have clients who are happy for them to invest in SEIS and EIS, or is there a kind of different risk profile? Or I'm just trying to work out what the client appropriateness is for each.
What we tend to see is that it tends to be EIS investors who are quite happy to put a component of this annual contribution into EIS and put a component of that into SEIS alongside an EIS portfolio. We have very few clients that focus entirely on SEIS. It's really part of a wider EIS plan. So it's, but then again,
they might do a bit of a hybrid, where they do a bit of SEIS and a bit of EIS kind of on top.
Yeah, and going back to this idea that with SEIS you want to follow your money into the EIS. So you'll often see them seeding effectively their portfolio with an SEIS round, but knowing that next year they'll put money in the EIS.
See, gotcha.
So it's always a combination.
Yeah. And I guess, Joseph, from a kind of fund manager's point of view, when you're talking to financial planners, obviously you need to explain to them, as Boyd has done already, these are really early stage, risky investments. How do you kind of set expectation levels there for clients?
Yeah, I think the risk question is a big one with SEIS, because I think a lot of advisors and investors have been put off by the perceived high risk of SEIS, and completely agree with what Alex said earlier. You know, I would not advise anyone, unless you're an experienced angel investor, to make a substantial investment under SCIS in a single company. The risk is just not worth it. The risk return doesn't make sense. But if you're looking at an SCIS fund that's going to deploy your cash across 20 companies, 20 investments that have that high risk, high return profile, your overall portfolio risk profile is actually really good. I mean, you would mention the tax benefits that you get on top and the loss relief, etc. You're actually really risking a fraction of your overall investment, and you have the potential to hit 3, 4, 5, maybe even more of those really large winners in that portfolio. So if you have that kind of portfolio thinking, portfolio approach to SCIS, the risk return profile actually makes a lot of sense. It's actually, not that risky overall in terms of the amount of capital they're risking, and you still have that very large upside on top. So I think when you show that you're using diversification, sector diversification in our case as well, and portfolio size to manage the risk of SCIS, then I think it makes financial advisors and investors a lot more comfortable to tap into that market. And once you've made your first SCIS fund investment, you see how it performs. Usually people then follow on and invest in later tranches because, to be honest, all of our portfolios so far are showing positive performance, which is great, sometimes very significantly positive. And that's usually driven by, 10, 20% of portfolio companies doing extremely well and driving the overall return as well. So yeah, that's showing that dynamics. And we're quite fortunate now. We have a few years of track record to prove that. It was a bit theoretical at the beginning to explain that, but now we have the investments and we've had the exits as well. So we can sort of demonstrate that in real life.
Classic portfolio diversification in that sense, then, yeah. And I guess there's a school of thought that says you make your riskiest investments at the riskiest time, and obviously this feels like and is a risky time. And Alex already said that they're extremely busy, probably busier than ever. So it goes to show that people are willing to make risky investments at the moment. Can you just give us an example within the portfolios? You mentioned the track record and the companies. Can you give us a couple of examples of companies that are doing well at the moment?
Sure. Alex mentioned a company that we're quite proud of, a company called Transcend Packaging. So they're a manufacturer of sustainable packaging products. I like using that example because it's not your typical ES investment. It's not a
tech investment. What's going on?
No, it's not tech. It's manufacturing. It's based in South Wales. It's a huge factory employing 200 people now. So they supply paper straws to McDonald's, Starbucks, KFC, lots of high food chains. That's the biggest sort of product line. They also manufacture plastic-free PPE for the NHS. They have a massive contract for that, and a range of other products. Basically plastic-free products. We invested at that company. It was brought to us by one of our angel investors. We invested at the business plan stage. So you now have this huge factory employing 200 people, but when we invested, there was nothing but a highly credible team with a very well thought of business plan, and actually the first contracts pretty much lined up already. So it shows you, and very quickly, we invested at a very modest valuation. The valuation at the time was around £1 million, the company valuation, and it's now a company generating millions of revenues. So you can imagine that the investment's gone up in value, quite significantly now. But what was interesting is that we invested at that stage a couple of years ago, at the beginning of the year. 6 months later, the company raised a follow-on round under ES at a much improved valuation already. So just in 6 months, that the value of that investment accelerated massively because it went from being a business plan to having contracts with McDonald's and other big brands like that. So the value skyrocketed pretty quickly. So it's an example I love using. I also mentioned quickly at the beginning that we had one of our early angel investments returning over 100 times the initial investment. So that was a 2013 SCS round in a company called Onfido, which is it's a tech company, identity verification company. So it verifies that your passport is real and belongs to that person. So that company, again, was at a pre-revenue stage when we first invested and has now raised over 200 million and has gone up in value incredibly. So it really shows you that when you get it right, the returns on SCIS are really massive.
Yeah, absolutely. That's some great examples in there. So Alex, you're going to say something.
I was just going to say it's also very important. You actually don't need great returns to get very good returns because of the tax relief. So, you know, if £1 becomes 120, you've doubled your money. If £1 comes £2, you've got what, a five and a half times return. So, and probably over your entire portfolio, it probably won't really, you know, if you do get two times your money over 8 years plus the tax relief, it's a hell of a good investment.
Yeah, it's not a bad deal. Absolutely. Absolutely.
I can just add something to that.
Yeah.
You also, because you invested at the SCS stage at a relatively modest valuation. So typically our average valuation for an SCS investment is around 1.5 million company valuation. You don't need a unicorn to actually deliver a really nice return. You know, we've had exits at, you know, the 5 to 10 million mark that return a very nice multiple because we invested at that relatively modest investment valuation initially. So that's that kind of dynamics you don't really get with later stage rounds. When you invest at later stage, you do need the company to deliver a much larger exit, which
Yeah, no, absolutely. Absolutely. No, it makes sense because, yeah, you need the company to go big or go home in that sense, don't you? Boyd, I just want to ask kind of pretty much the same question I asked to Joseph in terms of just giving an example or a bit of a flavor of a company, an SEIS company that's done particularly well.
Sure. A couple of examples, as we were mentioning earlier, in the robotics sector. Two that come immediately to mind is Tethered Drone Systems, which is a drone system that is tethered 24 hours to the ground. So this is very useful in oil platforms and that sort of situation where it can monitor what's going on constantly and report back for any problems. And that company's done exceptionally well. But one thing I was going to emphasize there is it does take a long time for these companies, probably longer than the EIS companies, for these companies to mature, because there's always such a longer setup period for them and development. The other one I was going to mention is another company in the robotics sector, Fox Robotics, which does in-premises logistics, such as manufacturing, aerospace, and retail, which helps carry heavy loads that would have been done by humans before across very dangerous sites, such as in manufacturing. So those are two examples of companies that have done very well in our robotics fund, and you know they haven't exited yet, but all the signs are that they will achieve very good multiples. But of course they are higher risk, and until you actually get an exit, you're betting on a higher risk company.
Yeah, that's a good point. And I see James has very kindly asked the question, and he's also embarrassed me because I meant to say at the start, if you've got any questions, please do put them in the Q&A section or the chat section, and we'll cover those off as we go through or at the end. But James was asked a question about exits and how long it takes to return capital to investors. Obviously, it's great having a big return, great having a 100 times multiple, but if it takes 10, 15 years, then yeah, that's probably too long a time span. So Joseph, in terms of the work you do with SEIS companies, how do you help them get to that point? Obviously, when you're investing in them in the early stage, an exit's probably quite a long way away, but what steps do you take to get them to that point?
Well, what's happening at the moment, which is quite interesting actually, on the exit side. So we've had a few exits now. Half of them were trade sales at a relatively early stage, actually, just over 3 years from the investment. So they were not huge transactions, but again, as I mentioned earlier, because we're the first investors, we invested relatively low valuation, so the multiple was actually excellent. So it was almost 7 times on one of those, and we doubled the money on the other, excluding tax relief. What happened last year, we had 2 exits that were secondary exits, and that's really, really interesting for us because it means that you don't have to wait for an actual trade sale to occur to actually realize the investment. So a secondary is when new investors come in, usually venture capital, institutional investors, buying out shares from original shareholders. So the founders, as well as the early angel investors and funds like us. So those transactions, you don't usually sell your entire holding on those, but you will set a portion of that and return cash to investors at a very, very, very attractive multiple. So we had one secondary exit that returned 11 times the original investment. And the other was the 100 times exit that I mentioned, which was a secondary. So the company hasn't technically exited, but has returned capital to the original investors. So In terms of what that means for the work that we do with companies, we just have to make sure that they get to that stage, that they, not every company is going through the process of raising one round after the other, to be honest, but those that do, we make sure that they're connected to the right funds, that they obviously are ready for conversations with those institutional investors as early as possible, because not only does that increase the value of our investment, but it's potentially an exit opportunity for us as well.
Yeah, it's great to hear there are exits happening, and obviously from an investor's point of view, they don't care necessarily how it's happening, whether it's secondaries or it's IPOs or it's buyouts. They just want their cash back. I guess that's the criticism of SCIS. It's been going since 2012, it's almost 10 years now, but there aren't too many exits out there. Abad, it's probably a good question for you. Do you see a significant number or an appropriate number of, or enough in your eyes, I should say, SCIS exits?
Not yet, but we do tell investors on our side that whereas we tell them 5 to 7 years for EIS, we do tell them 7 to 10 years for SCIs. There will be exceptions, clearly. It's more of managing the expectations for investors. Now, we did start as a firm, we started quite late recommending SCIS funds, and that's partly because we require a minimum experience of the fund manager before we start looking at them. So we avoided actually the first mega funds that came out in the first few years. And also there was an issue around the government not necessarily, it wasn't clear in the first few years that the government was going to support SCIs for long term. So it's only when they got that deal, what's it, till 2025, what is it? Mark?
Yeah, sunset clause, yeah, 2025.
Yeah, so that's when we thought, well, okay, we've got now a good run that we can back EIS fund managers and SCIS fund managers. But there was more of a corporate decision around that. The SCIS funds that we are using, we've only been using them for about 4 years now. We've had a couple of secondaries opportunities. We've had some preemption right opportunities. And we've seen some follow-ons in the SCIs, in the EIS funds, but no proper exits other than 1 or 2. So it's, but they're starting to come through now. So that is exciting for investors, because then obviously there's an opportunity to reinvest the proceeds.
Yeah, I'm going to say, so clients are starting to see kind of money back in their pocket, as it were.
Yeah.
Yeah. Alex, same to you. I guess on the platform, are you seeing, I know you do a lot of interviews with fund managers, for example. When you interview them around their SCIS funds and kind of the EIS follow-on funds, are they talking more these days about exits and actually returning cash to investors?
Well, we've got Joseph here who is, but most aren't yet. But I expect what you are seeing is, you're getting material uplifts in valuations, and where you're getting serious investors going into those companies at a huge premium to what our investors have paid. So people are seeing actually their money is going somewhere. But it'll take time. It'll take time. As I said, we've only been around for 4 years, so most of our investors, they're not going. I suspect they'll start seeing exits now, because I think their market is getting so much maturer. Like the actual providers in the market, they're starting to get. They've got a lot more experience than they had. They've got a much better process probably than they had. They are starting to get exits. There's more competition coming into the market, and also just for the ecosystem for all these sort of startup businesses, so much better than it was. Every big city now has got all these sort of, growth hubs, etc., enterprise zones. So there's so much better infrastructure for once you actually invest in these companies for them to hopefully prosper. So I would expect our investors will start seeing sort of significant exits in the next two or 3 years.
Yeah, and I guess
they're part of a really exciting investment journey. There's a lot of these companies that in SCIS funds that are starting to do amazingly well and becoming well known. I think
we mentioned a couple
someone like Motif or someone like that, which is which was initially a fuel SCIS company. It's one of the fastest technology growing businesses in the UK, and there's a lot of very exciting companies coming out of them.
Yeah, and obviously the beauty of SCIS is you get in on the first rung of the ladder. You're pretty much the first investor in. You can go on that journey with that company and hopefully get those those 100x times returns that Joseph talked about a minute ago at the same time. And
that's where you're really going to get paid by locking your money up with a liquidity. You're going to hopefully get a far better return in the long term.
Yeah, indeed. Yeah. Avard talked about kind of expanding the scheme. Obviously, SEI has been going again since 2012. Keep saying it, but the numbers around the scheme and the amount of money that's gone into the scheme is pretty much kind of flatlined since the tax relief went down on the reinvestment relief. Is there anything we could do to kind of expand the scheme, make it a bit more attractive, perhaps up some of the limits? Boy, do you have any ideas about how SEIS could be kind of expanded?
Well, I'm a big proponent, as you know, of upping the limit from 150,000 up to possibly 250 or that sort of mark. I think 150 in today's expensive world doesn't go very far for some of these startup companies. That would be my major thing. I think the 50% tax relief is fantastic, and I wouldn't touch that. I mean, obviously it'd be great if it was more, but I think that's completely unrealistic. But upping the 150 to 200 or 250 would be fantastic. It would be really encouraging to these startup companies.
Yeah, and same again, Joseph. Is there anything you'd like to see kind of expansion of the scheme or changes or amendments?
I completely agree with Boy. That would massively help to increase the because the 150K today is not the same as 150K 8 years ago. It doesn't go as far, obviously. I would say there's also, I think, still an awareness issue around SEIS. A lot of investors are still not aware of the scheme, and when they become aware of it, they almost think it's almost kind of too good to be true situation. But we need to do a better job communicating about it, and also showing that yes, it's high risk, but there's now a real industry really of fund manager doing it properly. Doing it very professionally with a proper process, and so the risk is now managed. It's obviously not eliminated, but it's done now in a risk-controlled way. So I think communicating that and improving awareness within investor and advisor communities is really, really our challenge now. Because as you said, the numbers have been quite flat. It's 150 to 200 million that's invested under the scheme every year. I think we could do a lot more.
Yeah, it's certainly something I think everyone on the panel knows that we're lobbying for at the moment, trying to increase SEI limits from 150 to 250. Because as you say, you can burn off 150,000 as a company pretty quickly, particularly a deep tech or a med tech company. That's probably two scientists or two professors' wages gone in an instant. So if you could raise those limits, that would really help, particularly at the moment, obviously what's happening in the wider world, to really kind of get some companies some equity rather than debt, which is another big problem I think at the moment. But hopefully that will come to be. I guess on the other side of the fence, Alex, looking forward to kind of budget March time. People talking about wealth taxes or changes to pensions reliefs or CGT changes. Is there anything you're hoping for there, or anything that kind of sticks out?
No, I just I don't think we're going to get anything positive. I couldn't see them raising the tax release for EIS or SEIS. And I think my main message just to investors, if you're the right type of investor, which the advisors on this will only be talking to the right type of investor, you should be putting as much money as you can now. Once you've done your pension and ISA, putting it into VCTs, EIS, and then to a lesser extent SEIS. You really should. You should be making use of those tax shelters that are available to you, because at the moment they're hugely generous. And these things, it's like when I used to work in pensions, and remember when you could put 250 grand into a pension each year, and good God, at that time, anyone who could should have been putting that money in, because it never stays so generous for that long. So put as much as you can in whilst you can. Because
I guess that's
your money's going to get, if it's not in an ISA or a pension, it's going to be absolutely savaged by tax over the next few years.
Yeah, and obviously they're thinking about changing the pension tax relief rules yet again, aren't they? I remember when I was financial planner doing the old carry forward and carry back calculations, you could do 6 years and trying to do your 2 years, etc. It became very complicated, but you could put quite a lot of money, or a significant amount of money, into a pension. And now, I think its maximum is about 40,000, isn't it? So
that's right, and as little as 4 or none.
Yeah, exactly. And obviously, potentially, they're talking about tax relief being cut to maybe a flat rate of 20. There's kind of lots of cards on the table at the moment. When you're advising your clients, Avard, how much of potential maybes, ifs coming up in the budget? How do you kind of work with clients around that and kind of advise them? Because it must be very difficult in an uncertain time.
Yeah, I think the key is, and we talked a little bit about that before the session, but I think it's important to understand who is telling you the doom story. If a solicitor firm experienced in trust work and the family investment companies tells advisors, well, you really should think about not doing business relief because IHT is on the cusp of being withdrawn. They're obviously talking a nice story around trust work and family investment company work. I don't think, I'm actually quite positive that taxes aren't going to be increased. I'm quite optimistic in that sense. I think it's far more important to grow the economy. And if the economy grows, then the Chancellor gets more money. And so I think the encouraging growth should be far more important. I do think that pension investments don't necessarily go into supporting young companies in the UK. They tend to be invested in the large multinational companies in tax havens. So I think there could be a case for reducing pension contributions, but increasing contributions into tax advantage investments, where it actually helps the UK economy. So I'm hoping that maybe not this budget, obviously, but the next couple of years, that there's going to be a renewed attention at further encouraging investors to help the UK economy, as opposed to international businesses through pension funds. So yeah, that's what I'm hoping. I think, though, for this particular period before the budget, it's always good to think about, are there any gains that you deferred or could have deferred in the last 3 years that you still haven't? But then think about, have that conversation with clients. Think about what's the consequence of tax going up in the future on CGT. And if you're worried about that, and if you're an additional rate taxpayer or a higher rate taxpayer, and you understand investments, then think about the SEIS instead, because you can simply halve that gain, as opposed to having to worry about, a future increase in capital gains tax. So it's like housekeeping in that sense. You clean up any gains from last year and this year. It's an opportunity, maybe, if you're worried about CGT rates going up, it's an opportunity to sell that property that you probably don't want to go back to at some point either. So clean up your financial affairs, sell the assets at a relatively high CGT rate, and just simply halve it with an SEIS contribution.
Yeah, makes sense. And then I guess this time of year is also a consideration for carryback as well.
Yeah, so that's something to keep an eye on, because I've just had an email from one of the SEIS managers that are looking to bring forward, in fact, the deadline for carryback to a few weeks from now. So it's important to speak with the SEIS managers that you do work with, just to find out what the deadline is, and not just what the physical deadline is for the fund to make their investment, but also when you actually have to have the applications in. And this is now from a bit more COVID related. Just make sure that the fund manager can handle your check or your client's check in the application form, and whether you need to set up some form of digital application form process. Make sure that the clients are aware of that, so you prep them. So that's that may require you to have a chat with your operations team or with your compliance team, to make sure that they're happy with a changing process.
And just on the carryback point, could you just give us just kind of go back a step and tell us how carryback works with EIS and SEIS?
Right. Okay. Yes. So with EIS, just as a reminder, you've got up to 3 years from the date of the crystallization of that gain to use carryback from that point of view, from the capital gains tax deferral. For income tax purposes with EIS, you can go back to the preceding tax year. With SEIS, you've got carryback as well for income tax for last year, the preceding year. But if you are using income tax relief for last year carryback with an SEIS, you have to also then think about your capital gains reinvestment relief for last year. So income tax relief is linked to the capital gains reinvestment relief. So, for example, if you had a gain last year and no gain this year, you can't claim the income tax relief for this year if you also want to use reinvestment relief for last year. You then have to go back to last year to use your income tax relief for last year. So that's a difference with the EIS. Because with the EIS, the capital gains deferral is uncoupled from the income tax relief that you're claiming. So that's a sort of slight difference there. So that's important. But yeah, it is, have a chat with the SEIS fund managers that you work with just to make sure you understand what the deadlines are, and also whether they can actually invest 100% of that money. Because even though they may say we'll close on the 30th of March or the 5th of April, it could be that they only invest maybe 70% of that money in this tax year, and there's some carry over to next year. So just to get your ducks in a row on that one.
Yeah, that's a good point. Obviously, again, at this time of year, it's important to know about these different tax mopping up exercises. So it's a good point to be aware of. Thank you. Boyd, on that point that Avar kind of mentioned there around deployment, when SEIS funds raise their money, how long generally is it taking them to kind of get that money away and get it actually invested, in your experience?
Very much depends on the fund, because some funds can be very well prepared and have the investments already lined up and know what they're investing in. And it then becomes a question of raising enough money. But on the other funds or the other end, they raise the money and then take time to invest it. I would say for the latter, it can be 6 to 12 months if they haven't identified the right investments. But we would very much encourage the funds to identify the investments first and know what they're investing in, so that money can be deployed, especially coming up to a tax year end.
Yeah, and which way around are you, Joseph? Do you have companies ready to go now and you're just getting the money in, or is it get the money in and see which company you're going to invest into?
Yeah, I think as an SEIS fund, you have to be aware that your investors want the money to be deployed quickly, particularly at the end of the tax year. So for us, at any point in time, we have 20 to 30 companies in advanced due diligence. So we have a constant stream of deals. So we're able to do 2 annual closes every year. And we know how important the one at the end of the tax year is. So we absolutely guarantee full deployment in companies before the end of the tax year for investments made in the fund until pretty late. So until March. Obviously, it makes our life easier when the money comes a bit sooner than that. But we're aware a lot of investors think of SEIS, as the last on the kind of to-do list of investments before the end. So we know a lot of money comes in March, and we absolutely guarantee that money gets deployed in companies before the end of the tax year, actually. So this is our 7th, it's going to be our 7th tax year end. And so far we've got a 100% success rate in terms of deploying the cash. So no reason why that won't be the case going forward still. But yeah, no, it's very important. We're aware of the importance of carry back as well for a lot of investors. So you have to be deploying the cash. Right? You can't sit on that money for month and month. It's not what SES is about, in my opinion.
And you said you have a stream of deals ready to go. Where do you get that stream from?
Yeah, so we've got really good relationships now. As I think Alex made a very important point earlier, the whole ecosystem has matured so much in the past few years. The kind of companies we see now, even at the SES stage, compared to a few years ago, is nothing like it. It's nothing like it used to be. So we've got great relationships with fantastic accelerators. Universities are doing really, really good job having proper incubator programs as well. So you got fantastic science coming out of universities with proper commercial strategy now in place. So it's all about having those relationships, and having been an STS fund for 7 years, we're quite well known as an investor that can put money in very early and very quickly. So it's about having those relationships. So I mentioned accelerators, university incubators. And we manage an angel network, so a network of business angels who bring a lot of deals to us as well. So that's a fantastic source of deals, because you've got someone bringing you the opportunity that's putting money where the mouth is. So that's been great. And one point I wanted to make as well is that it used to be very much a London-centric industry in many ways, and that's changed now. I mean, obviously COVID accelerated that. There's no point really being in London anymore. Especially from a funding perspective, doesn't really make any difference. And we see companies now from all over the UK. So our deal with the British Business Bank is about deploying a lot of our cash actually outside of London. And we see fantastic opportunities in sectors that are maybe a bit different as well. So I've mentioned, investing in manufacturing in Wales. These are another type of opportunities that you will see on your doorstep if you don't, go out of the M25. So that's been a major change in our small world, is seeing companies from different parts of the UK coming with very different opportunities. So the deal flow is fantastic. I would really emphasize the deal flow is not the bottleneck. We want to see more money on the SCIS. There's more opportunities still than funds available, I would say.
Yeah, okay. That's good to hear. We've got about 5 minutes to go, so if you've got any questions, please do send them through. We'll start obviously to wrap up. So let's perhaps, see if any other questions come through, ask a final one for each of our panelists. Just looking ahead, obviously we're 7 days into a new year. What are kind of your hopes and expectations for 2021 in terms of SEIS in particular, but more widely in kind of early stage investing? Alex, can I go to you first on that one?
Well, I think it's on fire. I think people, obviously there's a tax reason, but I think people are suddenly waking up to the fact that they can make a lot of money this way, and that it's an exciting, tangible way to make money by investing in young, early stage businesses. So I've got very high hopes for it for the current year, assuming there's nothing really nasty, but and over the long term, I think it's going to become a much more mainstream thing for people to do.
And are you expecting more money? Because obviously last year, fundraising was kind of hit with COVID, obviously coming around in March, April, which is tax year end, obviously. So for a lot of funds, a lot of the industry, the money was down. Are you expecting that money to kind of come back this year and this be a bumper year?
Yes, well, I say our business is up 50% since April, actually. And I think there's huge demand for it. Absolutely huge demand. And I don't see that it's going to decrease. I think it'll only go up. And I can't see anything. I can't see things like pensions getting more generous. I can't see the tax regime getting more generous. But that's going to force a lot of money into these types of investments. And I think people need to be talking about them much more. Like SEIS, for the right type of person, it's absolutely fantastic investment. We keep talking about risk. And that's the trouble when you talk about these products, because you have to include everyone who would never ever invest in an SEIS or shouldn't. You always have to talk about how risky they are. But as we said earlier, for the right type of person, you're risking 13.5p in the pound. So it's I can't think of a much better investment, and especially when you can consider what the upside could be.
Yeah, I think it is the most tax relieved investment scheme in the world, the SEIS. So it's use it or lose it, I think is the case there.
And we did talk about exits. Our clients have had an exit on one of the first SEISs which we did, which was an Amplify one for music companies. And with tax relief, most of them have doubled their money and actually got the money back. So there are, and there's more and more stories of people getting their money back, and that will only increase.
So I guess also with perhaps changes being made to pension tax relief or other taxes being raised and cut, if SEIS stays as they are, that makes them comparatively more beneficial and attractive at the same time. So I guess that's what it's got.
Right. Well, they're really the last place you can invest. If you're a high net worth investor, they're the last place you can go.
Yeah.
And a very good place to go.
Absolutely. I agree. Just for the last three of you, we've got 2 minutes left. So perhaps just a minute each on what your hopes and expectations are for 2021. Boyd, do you want to go next?
I was just going to add to what Alex said. It's really positive, very excited about this sector, and to emphasize that there actually is a lot more interesting startup companies coming through. That could be a result of COVID and people deciding, you know what, I'm going to do what I've always said I'm going to do. I'm going to do that startup company. So there's a lot more exciting companies coming through from that end. That would be my hope, that we encourage them.
Brilliant, thank you. Good rallying call so far. Ivan?
I think history, if history tells us anything, in times of great crises, great companies are formed. And we've seen this in 2001, we've seen this in 2008. It's always great opportunities. And so, we've seen stock market being a bit crazy, but we talked about this earlier. If you want to get into the next Uber, you have to start with an SEIS fund.
Simple. Thank you very much. Joseph, last word to you.
100% agree with everything that's been said. If you think of everything that's been happening the past year or so, huge challenges been appeared that will be solved by early stage companies. There's no doubt that companies formed in 2020 and 2021 are going to be the next unicorns, and are going to solve some of the new problems that we face now. So it's unlikely that incumbents will be able to. So we're looking for innovation to solve our challenges. So that's what SEIS is about.
Brilliant. Thank you very much. Nick, I see you just sent a question in. It's probably a little bit too late to answer it. But what I would suggest, if you come back tomorrow for our session tomorrow at 10 o'clock, which is an open forum, so we're actively asking you guys to be in charge tomorrow as attendees. So all the questions that we've been put into our panel will be your questions. So please do fire through as many as you can on the Q&A and the chat tomorrow. Otherwise, it's going to be a pretty awful, quiet session. So please do get involved as much as you can tomorrow. It could all go horribly wrong, probably will. So we'll see how we go. But for today, thank you very much to Joseph, to Ava, to Alex, to Boyd. If you do want to get in contact with any of them, please do get in touch with me and I can put you through to them so you can have a chat with them and pick things up. But thank you very much for today. SEIS has been covered. It's good to shine a light on it. And I think there's some really great stories out there around SEIS. So long may that continue. All right. Thank you very much. See you tomorrow at 10 o'clock.
Thank you.
Cheerio.
Thank you.
Bye-bye.